And welcome into the program. This is your game plan for retirement with Northwestern Ohio's resource for a common sense approach to planning for your financial investment and retirement future. He is president and founder of McIntire Retirement Services. Chris McIntire here with us. And today on the program, going to be discussing one of the more debated financial products. There are a lot of financial products: stocks, bonds, mutual funds, ETFs, notes, a whole variety. But annuities specifically are pretty widely debated, a lot of confusion, a lot of misunderstanding, and Chris McIntire here with us to help us sort through all of that to determine if an annuity may be appropriate for your financial situation and your retirement. So, Chris, welcome into the program. Always a pleasure to have you on. And would you agree with that assessment of annuities?
Yeah, and I would, you said people are misinformed, because there is a lot of misinformation out there. And if we look at the broad investment landscape out there, right, we deal with companies that supply mutual funds to people, companies that, supply other types of instruments, real estate investment trust, REITs, right? I'd have a bigger issue with a REIT than I would with an annuity, okay? But there is a lot of misinformation because they want the money to shift, here, there, and everywhere. So we're going to cut through the bias and all that and stick with real good quality information on here. And you certainly don't put all your eggs in one basket no matter what.
Yep. Well, if you've got questions, if you have heard about annuities and would like to find out more, if you are considering a deposit or purchase into an annuity, if you already own an annuity and just want to get a better understanding, this show is for you. So do stay tuned. And of course, you can always give a call and have a personal review with Chris and the team from McIntire Retirement Services. They'd be happy to hear from you and help in any way they can. Just give a call, 419-332-0532, 419-332-0532. Chris, part of the problem, and maybe where this begins, is that retirees have kind of heard two things: either that an annuity is the greatest retirement planning vehicle ever, or they are something to be kept away from at any and all costs. So why is there such debate here, and why is it so divided in the opinion about annuities?
Yeah, and sometimes it depends on how the advisor's compensated, what is their business model, and are they being told from the corporate hierarchy what you have to do for clients to fit our business model. We're independent, so we don't have to answer to anybody, which is nice. Annuities pay commission, so sometimes that can give a bad rap. Obviously, if you buy mutual funds, you might even pay a commission on that as well. Let's do a generic piece here, Peter, example. So let's talk about somebody that buys a 5-year annuity that's paying 5% interest, okay? Right? You've heard of a CD paying 5% interest, okay? That insurance company is going to pay the agent who writes that policy or who writes that business a commission, okay? And typically it's one time on an instrument like that, okay? There are other annuities that you may structure for a lifetime income stream that has an income rider, and you cannot take all the money out of it till the end of the 10th year. Okay. And because it's a long-term investment vehicle, the insurance company paid the agent a commission. So, that money came from the insurance company. So they need to make sure they've structured that product so that the insurance company is safe and stable and that they get to make a little bit of profit. They pay the commission to the agent, and also deliver on the promises that they've made for the client. And when you spell all those things out, here in the state of Ohio, there is no annuity that can have a longer than a 10-year surrender charge schedule by our insurance laws. Insurance is regulated on a state-by-state basis. Nor can it have more than a 10% surrender charge. Okay. So if you put in $100,000 and took it out 6 months later, you might only get $90,000 out. Okay. But you see that spelled out in the contract. Okay. And I'll give you an example. I bought SpaceX stock, and some of that is down 25%, right? But everybody says, yeah, but you can sell it and get out of it if you want to. I said, yeah, but I had a 25% surrender charge for getting rid of it.
Yeah.
Okay. And
Uh,
But anyway, go ahead, Peter.
Well, Chris, you mentioned the commissions as the compensation structure, as opposed to maybe fees along the way for other types of investment accounts that might come out of the client's account balance. And so on one side, we've got a fee from the client for money in the market that we don't necessarily know the direction day to day. On the other side, we do have an upfront commission that comes from the insurance company, not out of the client's pocket. Is this a potential conflict with best interest for a client? Does any kind of commissionable product create the potential for a conflict of interest?
I could make that argument. Certainly it could. We do annuities, we do life insurance, we do long-term care insurance, and nobody worries about the commissions paid on a life insurance policy or a long-term care policy or even your health insurance or your property and casualty insurance, that people are getting paid on that. But for some reason it gets so entangled here in the financial services industry. So our business, Peter, we are a fee-based platform. So we do manage money in the stock and bond market for a management fee that is ongoing for as long as they're clients. Okay. We will do a 5-year annuity that pays us a 1% a one-time commission, and then maybe after 5 years, that annuity we renew it and maybe earn another commission on that. That's just the way that business works. And when you spell that out and lay that out for the clients, a lot of times like, oh God, I had no idea that's how it worked. All I ever heard was, one of these investment platforms that says, we don't believe in annuities and neither should you. Okay?
Mm-hmm.
Well, how many people mail their Social Security check back because they don't like annuities, or they mail their pension piece back?
Yeah.
Okay. So not every annuity, Peter, is going to be designed so that it pays people lifetime income. Again, like a 5-year annuity paying 5%, somebody just wanted a safe money strategy and it's tax deferred. They didn't want to pay any tax until they took money out of it. So, that's an advantage as well. We do a lot of annuities that have that lifetime income feature as well, because guess what the number one concern of American retirees is
Oh,
running out of money. Okay. Well, how can you run a retirement management business and not offer the one instrument that can remove that risk? It's ridiculous.
yeah, absolutely. And Chris, you also mentioned the surrender charges. So they are not completely liquid, and that is something that we absolutely should be aware of the liquidity restrictions, when our money might become liquid completely without any type of charge or fee on that. But that surrender charge for an individual getting into an annuity contract is seen as one of the drawbacks, right? But at the same time, if you have heard the term a run on the banks, like what happened in the Great Depression or even more recently with Silicon Valley Bank, the bank does not have in place surrender charges. So if everybody rushes in all at once, the bank takes a loss and could go under. As a whole, surrender charges on annuities are actually in place for the protection of all the clients. And again, as an individual owning one, we look at it as a drawback, but as a collective, those surrender charges actually make sure that the insurance company that has made these promises and guarantees remains intact and remains stable.
Yeah, and they get audited by the State Department of Insurance. They get audited by the ratings companies as well. Just to throw in some of the, some things that should give you some peace of mind. And
Some of the
yeah,
safeguards. Yeah. Yeah.
yeah, it's supposed to be a boring industry. We like it that way, believe it or not. And it's just when, not everybody needs to have one. If somebody's 90 years old, you don't want to put them in a 10-year annuity for crying out loud. And, they may need the liquidity. And, many annuities, even though they have surrender charges, have waivers in case you went into a nursing home or had a terminal illness, or if you died, the money's fully available without any of those charges. So, And obviously, you can sense some passion in here because we're in the industry. I just had a client review who had a fixed index annuity. They made 9% last year, and they can't lose that money going forward. They didn't pay any management fee on it. They don't care that I got paid by the insurance company. They're happy they made 9%, and we start another year, because the stock market was good, and an index annuity links your performance to a stock market index. And, there are times when, when the interest rate environment was very, very low, hey, everything was tougher. And now today with bond yields up there at 4.5 to 4.6 and 7%, but a pretty sweet spot in the annuity industry right now. Great earnings potential out there.
Well, if you'd like to find out more, if you've got questions, if you'd like to see if an annuity is appropriate for your situation, and if so, what type of annuity fits your goals, your objectives, your timeline, pick up the phone, give Chris McIntire a call, 419-332-0532, 419-332-0532. Again, Chris, there is confusion with annuities. They are not without some kind of complications. I think that maybe the biggest one is that there are different types of annuities. And so if they get lumped in all together, these different types do different things. They perform different jobs. They have different nuts and bolts. It's kind of like saying, well, you need a vehicle. Does that mean a skateboard or a bicycle or a sedan or a convertible or an SUV or a dump truck, right? They all do different things. And if we are expecting a dump truck, but we get a bicycle, we might not meet our expectations. And I think that that is another part of where the confusion and some of the frustration with annuities might lie.
Yeah, great analogy. You don't change a flat tire with a hammer,
No.
right? You know,
Different
yep.
tools for different jobs.
Yep. You need a tire iron and a floor jack. And then, if you want to not worry about running out of money in retirement, then maybe you need a portion of your nest egg allocated to an annuity. And then the rest of it can be allocated to stocks, bonds, mutual funds, whatever is in your risk tolerance, maybe even a CD at the bank or a money market account, right? So, you're always going to have some money you need for your short-term emergencies, right? And then you have some money that's in maybe in the stock market, but you don't use that as an emergency. But if you needed to, you could sell, right? Just had a meeting with a client talking about getting a mortgage on their house, and we said, okay, all this money here is very liquid. We can get it out, okay? And then maybe you need some money for later on down the road, and that's why you put it in the annuity there. And believe it or not, sometimes the surrender charges guarantee that money's going to be there because nobody wants to take a hit to get some of their money out.
Yep. Well, Chris, you mentioned annuities with a fixed interest rate for a set period of time. And then you mentioned the one that can share in the gains of the market in years where the market has growth. So those are two different types. And I take it that those are types that you would utilize. Are there types of annuities that you would not utilize, or what are those defined as?
Yeah. Thanks, Peter, for leading me into that there for sure. You've got the multi-year guarantee annuity, the index annuity, and then there's also called the variable annuity. And that's not something that we've ever done in our practice, just something I'm not in favor of. A variable annuity, lets you participate in the growth of the stock and bond markets directly through buying mutual funds. And then it has what we call an insurance wrapper around it for the tax deferral, maybe the lifetime income as well on the variable annuity. But along with the risk of investing in the stock and bond markets, and the companies that need to deliver on those promises, because the stock market can go down sharply, and somebody puts in 200,000 into a variable annuity and a year later it's got 150,000 in it, but the insurance company says, hey, no matter what, we're going to pay you, a certain dollar amount every year for as long as you're alive. There are some additional fees and expenses that come along in the variable annuity space that you will not find in the fixed or the index annuity. So, nor the risk. So we're just not personal opinion, not a real big fan of the variable annuity from the inherent risk, and then all the expenses that come out and come along with that. We're fine investing in the stock and bond market. We want to do it as cost efficiently as possible for our clients, under our fiduciary responsibility to them.
But fees are another source of ire for annuities, and there's kind of a perception that all annuities have these high fees. Chris, you're saying that is not necessarily the case?
That is correct. Yeah. Yeah. Like a 5-year fixed interest annuity, no fees or expenses typically on something like that whatsoever. The insurance company's got the money for 5 years. They make money off of that, in what they invested in, typically bonds that will mature in a 5-year time frame. The index annuity is the same thing. Some of those have no fees in them whatsoever. If you want a lifetime income provision on it, then you may add an income rider that may have a charge on it, but you would know what that is, when you're signing the contract for sure, because annuities are contracts.
So, Chris, you mentioned in that 5-year fixed that the insurance company is making money. If they can make more money, why would I not just go and do that instead of purchasing that fixed rate annuity?
Because there's risk involved in that, Peter. And people who put money into those types of accounts want to do it because it's more conservative minded, and they like the protection of some of the world's largest corporations as well.
All right. Well, I guess some myths here then, Chris, about annuities. Number one is that all annuities are the same. I think we've already debunked this as a myth.
Oh, yeah, there are so many different types out there, from 2-year annuities, 3-year annuities, 5 years, fixed, index, variable. You cannot just make a blanket statement and say nobody should ever have an annuity. That's crazy.
Number two, that you lose your money or lose control of your money. You don't necessarily have to give that up, right, Chris? I mean, in fact, we might be taking more control over certain elements.
Yeah, absolutely. Because if you know that if it's a type we're going to do, how much you would lose if you cash it in early because it's spelled out in the contract. Okay, SpaceX stocks does not do that. They didn't give me that guarantee when I bought into it. And yeah.
Chris, number three, that you would lose control forever. I think there is a perception if you make a deposit into an annuity that that money is gone to you forever. You've already mentioned that there is a period of commitment, but even by law in the state of Ohio, that can only be so long.
Yeah, it's absolutely right, Peter. And then when people die, the insurance company does not keep your money. That's why you list beneficiaries. Okay. That being said, okay, I could take $100,000 and go out and buy an immediate annuity that would pay me a pension payment. Okay. And I could do it where it's just a single life annuity where if I died, it would be gone. I would get a higher income payment for that, but I've never done one of those.
So those are things you can evaluate and choose from various options. But again, something that you would absolutely want to know before you get in, what the stipulations, what the requirements, what the commitment is.
Yes, and if you were going to do some type of payout settlement option, there are many different types of those as well, just like it would be if you were choosing your pension payment.
So, Chris, when do you think an annuity makes sense? Who is a good candidate for consideration of an annuity?
Yeah, and that's a pretty broad-based question. So, typically that 5-year short-term fixed interest rate annuity is for a more conservative-minded individual. Okay, somebody who's probably a little bit older as well, right? Annuities withdrawals before 59 and a half would have a 10% penalty on the earnings. So it's not something you do for a 40 or 45-year-old person. We're typically looking at 55 and over when we do the annuity piece. Somebody who maybe has, some limited resources for their retirement and they want to guarantee that they've got some income throughout their lifetime. Okay. People who are a little bit risk adverse that say, the stock market's been very good. I still believe in it, but I'm looking for an alternative that I can participate in the growth of the stock market, but I don't want any of the downside, right? And that's everybody that's listening to this radio show right now.
Yeah. On the other hand, Chris, are there specifics or situations where you can evaluate and just say an annuity is absolutely not appropriate in this situation?
Certainly, yeah. If somebody's got $25 million, for example, right, they're probably not worried about lifetime income. Okay. If somebody is has limited resources and needs that liquidity means, I mean, that might not be a good fit for certain annuities, right? I mean, we can get 2-year annuities, 3-year annuities. So, but there are instances where we say, you know what, you're just not a good candidate here. You don't have enough money to generate what you need to. It would take all of your money to do this, and that's not something we would be comfortable with. And having a little bit of gray hairs, you've been in a lot of situations, and when it doesn't fit.
To the $25 million individual, though, I actually have heard Shaquille O'Neal speaking on the value of annuities as part, obviously, of his investment portfolio and planning.
Sure, absolutely. He may be taking advantage of the tax deferral. Absolutely, yeah. Because we were working with some higher net worth folks, and they were layered with CDs in there, and it spun off like $300,000 of interest for them. And I'm like, if we put you in a couple of short-term annuities here, we could probably save $60,000 on your income tax bill. He's like, why didn't anybody else tell me that? It's like, well, because it's not their business model.
So, Chris, you've mentioned some of the benefits of considering an annuity, what they can perform, protection, guarantees for income, growth without market related risk. Are there alternatives to annuities that can do these same jobs?
Well, with an annuity being contractually guaranteed, it's hard to find that in a bond mutual fund, for example. But we also create income using other instruments, not just the annuity piece, right? We use structured notes and, through our partnership with Brookstone Capital Management, dividend paying stocks, bonds, but the annuity being a contract with an insurance company, that's where you get, some extra layers of, a confidence building that, hey, these guys have the wherewithal to make sure that even if I've spent all the money in my annuity, I'm still getting a paycheck.
And you mentioned, Chris, that rates are actually pretty attractive on annuities right now.
Yeah, they sure are because, insurance companies buy lots of government bonds as part of their, to keep clients' money safe as well. They're limited in what they can invest the money in. And I think today, here we are toward the end of July, 10-year government bonds are about 4.6%, right? That's above what the federal, what you're going to find in a CD by, pretty substantial amount. So yeah, we buy 5.5% CD rates all day long.
Chris, I understand there also can be some healthcare related benefits with an annuity as part of the retirement portfolio. Can you elaborate on that, or myth or fact, or explain where that might come from?
Sure. Yep. Absolutely. And a good buddy of mine, we put some money into a fixed annuity for him, guaranteed to pay him a certain interest rate. And it was actually 6%, probably about a year ago when we did this. And he put in, let's just say, I'll use just to make up a number, say it was $100,000. Okay? And immediately, if he had to go into a long-term care facility, he had a pool of money of $300,000 to use to help pay that nursing home bill. The older that he gets, the larger that pile of money that would pay out in annuity payments would continue to grow. And so when he hits like the age of 83, which is the average age of claim here in Ohio for long-term care needs, I think it would pay out probably $7,000 to $8,000 a month, okay, for 60 months. So that's a nice hedge against the nursing home bill. If he doesn't go into the nursing home, he's got his annuity piece with his original deposit growing by 6% interest rate, and for a certain number of years, and then if he wants to, he can cash it in and go do something different.
For something like that, Chris, is there medical underwriting requirements to get into it? Because I know that can be prohibitive for kind of traditional long-term care, other types of approaches.
Yeah, yep. And some of them have some very basic, 6, 7 questions for the underwriting because remember, it's an annuity, so they've got the money, they're going to pay you an interest rate. If it's not like it's the strictest underwriting of just buying a long-term care policy, right? Right. There's the annuity piece. The insurance company, you gave them $100,000. The underwriting on those can be a lot more simplified.
So if somebody is wondering, should I have an annuity? Should I buy an annuity? What are the next questions that they should be asking themselves in that consideration, Chris?
Yep. What are the specific objectives you're looking for? Is it the safety side with growth linked to the stock market, or is it just I want a good competitive interest rate, or I really am concerned that we're not going to have enough money for retirement. How can we hedge that risk? And you can put money into an annuity now and then not take the income for 5 or 10 years down the road, and that actually that payment that they will give you continues to grow and grow and grow. Then the longer, so sometimes the earlier you do it, the better it is down the road.
Uh, Chris, are bringing it home here. Are annuities good, bad, ugly, or a specialty novelty only for a very specific situation? What is your assessment?
Well, I think most of the people listening to this show are very happy that they get Social Security and like that, and makes up about a third of the retirement income for people over the age of 65 in the United States. So, why wouldn't you want to, use an instrument that can help you plug that income gap that you have that's contractually guaranteed? And it actually, in many cases, Peter, it frees up other money because the insurance companies are handling the payout and the payouts increase over time. That may be less that you're relying on your investment portfolio so it can grow and help replace what you're paying out.
If we are wondering or considering, how do we go about the process of finding the right or the best fit for our
Yeah.
situation, Chris?
Yeah, and you want to sit down with somebody that knows this landscape very well, and that can talk you through the good, the bad, and the ugly of all the different pieces, right? No, there's no stock that's perfect. There's no annuity that's perfect. You need somebody who can give you the real information, without any bias whatsoever. We're probably licensed with 15 different insurance companies right now, being independent. So, we like the independence. We think it serves us and the clients, more importantly, better.
Well, once again, ladies and gentlemen, if you've got questions, if you would like to find out more, if you're considering or already own an annuity, or if you would like to structure your game plan for retirement and in that process, evaluate all of the financial tools that are out there and available and determine which are the most appropriate for your specific goals. That's what the complimentary courtesy initial review and strategy session and the design of your game plan for retirement are all about. All you need to do to get that conversation started, pick up the phone, give a call, 419-332-0532, 419-332-0532, 419-332-0532, or online at McIntireRetirementServices.com. Chris, again, annuities, pretty widely debated, some confusion, some frustration, some misunderstanding, but we appreciate you cutting through the noise and helping us get a better understanding.
My pleasure. Glad to be with everybody today. Stay safe and may God bless America.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntyre. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
The notes involve risks not associated with an investment in ordinary debt securities. The securities are not bank deposits and are not insured by the Federal Deposit Insurance Corporation or any other governmental agency, nor are they obligations of or guaranteed by a bank. The securities will not be listed on any securities exchange, and secondary trading may be limited. Therefore, there may be little or no secondary market for the securities. Accordingly, you should be willing to hold your securities to maturity. The securities are subject to the credit risk of the issuing bank, and any actual or anticipated changes to its credit ratings or credit spreads may adversely affect the market value of the securities.